All right, the Finance Committee will come to order, please. Good morning, everyone. Thank you for being here. Any citizens wishing to address the board this morning? None signed in. All right, we'll move on to approval of the minutes. Item 3, I'll entertain a motion for approval. Motion by Dr. Weber, second by Mr. Bose. All in favor, please say aye. Aye. Opposed? Motion passes. All right, CFO report. Ms. Clark. Good morning.
Good morning.
Turn that on. I just wanted to give the committee a couple of updates. Our auditors have left the field. We do have draft audit from BKD, and Chris Clark is scheduled to present next week at the full board meeting on the 14th. So we will have his report next Thursday. I also wanted to remind you, I've got a couple of comments from board members that you thought we may have left the financial report out of today's session. I will remind you that it's the 7th day of the month, and I have not closed November. So we will have. So.
Whoa.
Thank you.
Wow.
Thank you. I also wanted to remind you, I've got a couple of comments from board members. It's a rebound, so they're going to try. I should start row your boat.
Just make sure what you say the first time is right.
Yes, they're testing me today. Mendenhall, you will not get your capital request today. So November and December financial statements will be presented together at the January 25th Finance Committee. We're actually going to be closing November tomorrow. Because of the holidays, we moved Finance Committee so far up that we really have not yet closed last month. So just wanted to remind you guys of that. And those are my only verbal reports. And my other report is days cash on hand. This is just going to be kind of an update for you guys. It's a discussion topic. Not really expecting any action to happen. And then I have a couple of PowerPoint slides. These have been posted on your portal. And if the guys could be so kind as to pull those up. But they are on your portal. So as a reminder of what we're going to be talking about today, during the Budget 18 presentation, we board designated an additional $5 million into the JPS Future Fund. That brought us to about $117 million in this fund. Now, during the Commissioner's Court presentation in late August, we were asked to consider was the timing or when would we be recommending additional funds into this board designated fund from our operating cash. So we had talked about, as the committee, bringing back some rating agency information, as well as what did our peer group look like in Texas. So other public hospitals, what did their days cash look like on hand? And that's what we're going to be talking about today. And then in other Finance Committee meetings, you have asked, well, where do I feel comfortable with at days cash on hand? So when you start to look at our operating, and this is up on my screen, And have you found it on your portal yet? Now it's on the big screen. And we look at a similar graph every month. I show you 2 years worth of historical as well as the current year. So this information is something you should be familiar with. And as you look at the graph, I'll remind you, we get about 40% of our operating funds from property tax revenue. And if you pay property taxes, you probably remember that they are due on December 31st, but they're late on January 31st. So if you're like me, you circle around the post office until January 30th, and you kind of drop it in the blue box, which is probably the only thing you put a postage stamp on. So it is postmarked just in time not to be late. And you see that bolus of cash that we receive in January and February. And that's where we get our high point during the year. And most public institutions have that same effect from the ad valorem revenue that we receive. So our low point, you can see, is in November at about 177 days cash on hand, and our high point is in February at 283 for the 12 months. Our average, if you just take a simple average of those 12 months, ends up at about 226 days. Now, this is the S&P calculation, kind of the rating agency calculation, but we have removed the JPS board designated future fund because we don't intend to spend down that $117 million for operations. So I didn't want to count the board designated fund for operational purposes. So when you look at our operating expenses, it costs us about $2.5 million a day in expenses. So that kind of gives you an idea of what the relevancy of the day's cash on hand. So we're averaging about 226 with a high of 283 and a low of 177. Are there any questions on this graph?
The JPS Future Fund, is it just another bank account we have that's actually unrestricted funds that we just set aside, or how does that work?
It's actually not a segregated bank account. It's just earmarked money on our balance sheet. So it's an accounting tool that we use. We kind of just earmark those funds on the balance sheet. So it's not completely segregated funds.
Unrestricted. I mean, it's just a definition.
Yes.
Okay.
Correct.
Okay. Thank you.
So on the second page, and these are prior year FY16 numbers because that's what is public at this point in time. I was able, if you look at those green bars in the center, that's our peer group in Texas. The first green bar with 202 days above it is JPS, the Tarrant County Hospital District. And again, these are 16, fiscal year 16, so we can compare ourselves to the other four large hospital public hospitals in Texas. You can see El Paso, also a 9/30 year end at 37. Dallas at 65. San Antonio at 195. Now they have a 12/31 year end, but that's pretty comparable, still right before the large January, February receipt of cash. Harris County in Houston has a 2/28 year end. So if you think about the flow of cash into their account, that would be at the very highest point. So I've shaded the 228 column in gray and used some resources to get the cash balance at 9/30, which would be more comparable to the point in time where the other 4 hospitals would be at their year end. And they average at about 100 days cash. So that would be at a more consistent time frame. So the 5 green bars would be pretty close to the same point in time for the 5 large public hospitals at their year ends for 2016.
Right.
And those numbers don't change to a large degree. Now, El Paso, if you look at them closer to today, they're closer to about 60 days cash on hand. Asking some questions, they had their children's hospital that was associated with that system file bankruptcy, and they have recovered from that a bit, and they are closer to about 60 days cash on hand now. So don't really mean to get into that, but they were at the low point. But so you have 2 that are around 60, you have 2 that are around 200, and then you have Houston that is at around 100 days cash on hand. So
I have the same question that I have. Of course, we just have this definition that sets aside $100 million. I'm assuming that El Paso and Dallas County probably they don't have $500 million sitting around, but what does everybody else have sitting around in a futures fund that they don't intend to use but could if they needed to?
I really would not be able to answer that. I can say that the other 4 have much larger debt service. They have more debt.
Right.
So their buildings are newer, and whereas we do not. So you would have to do a much bigger dive into their facilities, and I don't know their balance sheets, and there may not be one person that would be able to answer that detail for me.
Well, I'm not against us saving money. That's not where I'm going with that.
Right.
It seems it's very difficult.
None of us thought you were going there.
Yeah, I don't know how reliable
It's
any
not,
of
this
these numbers
is,
are, right?
No, and this is just, again,
Just a point of
there's
interest.
not, it's a point of reference. There's not any conclusion necessarily that you can draw from those 5 graphs. I was just asked some questions, and again, this is just a point of reference. It is not, and as I start to talk about the 2 blue bars as far as the S&P ratings, I've gotten some questions from board members about what does it take to be a AA rated? What cash do you have to have in the bank
Right.
to be a AA rated hospital? There's not one answer to that. It's a multi-factor rating, and as you can see in a minute, I've got it's in very small print, but I've got the ratings of those hospitals below the bar chart.
Right.
And, some of those hospitals have AA ratings with very low cash balances. But it's not the cash balance that necessarily drives the rating. So it is just one of dozens of factors.
But we could redesignate half of that 100, and it would raise this number. And in practical terms, operating wise, it would have 0 impact on us, right?
Correct.
So
Correct.
if that would make the difference, a redefinition, it seems like it'd be an easy decision.
Right, and it would not necessarily have any, us moving the cash around on the balance sheet would not
'Cause they see
drive
through
a
that.
change in our rating at all.
No.
Yeah, and I'm not
These people
suggesting that it
understand
would.
that. Okay.
No,
Right.
this is just answering the question that a few people had about if we were to spend our cash, would that potentially have in the future an impact on our bond rating? Eventually, I think it could have an impact. The issuance of debt would also have an impact on our bond rating.
Right.
So this is just for information only.
Okay.
Yeah.
Not necessarily to draw a conclusion at all. So it's just interesting information.
This is in response to inquiry from the Commissioners Court about this, and then I'd asked you to take a look and make some presentation to us about it. So
Yeah.
not really a decision point, just some information to ponder.
Well, it'd just be easy to just look at this chart unless you actually pick up on the fine print. You walk away with the conclusion that's not warranted.
Right.
So,
Good news
So-
is we're not El Paso, though.
Yes, yeah, correct.
yay. It's a low bar.
It doesn't very-
I'd rather have the account, no matter what it's called, than not to have.
Yeah.
Yes.
It's nice having those,
We could beat them in a war.
yeah, it's
Okay.
nice having those dollars there.
So, and again, you know, the blue bars to the left of the graph are the AA rated average of about 264. Those are for kind of a revenue pledge situation, which we do not have as a public entity. The next blue bar is the S&P A-rated standalone credit, which we do fall into, which is a tax revenue pledge. The average is 251 for an A standalone, which I have been advised is really probably where we should start to compare ourselves to for this comparison purpose. But and again, we're at about 202. So for that comparison purpose, we are in the ballpark at 202 compared to the 251. And I left the AA rating because that's where most people want to know, well, where are you compared to a AA rating S&P? And the fine print below those graphs, there's 3 ratings that we can go out as institution. There's Standard & Poor's, there's Moody's and Fitch. Very few institutions do all of them. And if, for example, under our bar, the first green bar, we are AA minus, AA3, and we are not rated by Fitch. So there's an asterisk. And then if you look at El Paso, S&P has given them an A minus with a negative outlook. Moody's is an A1, and Fitch is a AA minus. So they're kind of all over the board from those 3 rating agencies. And you can see Dallas County, you can see Bexar County, et cetera. So, and this is just information.
Any questions for Sharon on this? Any other questions? All right. Did you want to bring up our guest?
Yes,
the
I'd be
next?
happy to. The next item on our agenda is our annual presentation for our investments that are held at First Southwest Asset Management. Greg Warner. And Greg is a director, and Greg has been with JPS and our investment portfolio for at least the last 2.5 years. When I came to JPS at that point in time, Greg had just started to take over our account, and we were transitioning. And I'll let Greg tell you a little bit more about his experience and how long he's been in the investment business. So,
Have a seat, Greg.
And you can, if you want to, you can kind of touch the screen
Yes, thank you.
and then just push there to go forward.
Okay, good morning.
Good morning.
Thank you.
Morning, Greg.
As Sharon said, my name's Greg Warner. I'm a director and senior portfolio manager with First Southwest Asset Management. We are part of the Hilltop Holdings family of companies. I've been with First Southwest and the Hilltop Group for about 19 years now. We manage funds exclusively for public entities, mostly here in the state of Texas. So all of our clients have objectives and goals similar to yourselves, the primary objective being the safety of principal, followed by liquidity and then yield. Sharon just had a slide up, and it reminded me, we actually are investment advisors for a couple of those other hospital districts. The El Paso County Hospital District and Bexar County Hospital District are also clients of ours.
Don't mention El Paso, what I said.
Yeah, we just talked about that one going bankrupt.
They are, as you can see, they're in a slightly different financial situation than you are, and so that makes managing their portfolio a little bit more challenging even. I'd also like to acknowledge I've brought with me today Dan Grant, my colleague. Dan is one of our portfolio managers here, and Dan is actually one of the primary individuals who actually executes transactions for the portfolio. So when we're buying or selling securities, Dan is the one who's mostly working with staff to execute those transactions and to make those things happen. So he does all the real hard work, and I get up here and take all the glory and try to answer your tough questions. So have a brief presentation I'd like to go through. The idea is to give you a little bit of color, a little bit of background about the economic environment, the investment environment that we're in today, and then how that relates to your portfolio and what we're doing in terms of managing your investment portfolio. I'll start with just a kind of a recap of the last year and some of the significant events that have occurred. And of course, you know, one of the most important of those, no doubt, for financial markets was the election of Donald Trump as president. A very notable event. Obviously, you know, his presidency has not been without some controversy, but it certainly has been a significant event for financial markets. It's helped to spur stock markets onto record highs, and it's had a significant impact in the interest rate environment, and I'll cover some of that as we go through this here today. A few of the other important events, and this has not been as evident here recently, but North Korea. The missile tests and some of the geopolitical concerns surrounding North Korea have had an impact in financial markets and in the rate environment, particularly in the later part of the summer, where we saw interest rates were driven down by a flight to safety on some tensions surrounding North Korea. And of course, we had the hurricanes late this summer, Hurricane Harvey in particular here in Texas, but also the hurricanes through Florida and Puerto Rico. And those have had an impact on some of the economic data, both positive and negative. Something that's not as widely discussed, of course, is changes at the Federal Reserve. We are going to get a new chair of the Federal Reserve that has important implications for the interest rate and the investment environment. We also are going to have several other open seats on the Federal Reserve's Board of Governors. And in fact, President Trump is going to have what is pretty much an unprecedented opportunity to shape the future of the Federal Reserve through a number of appointments. Some very high-ranking folks at the Fed have resigned those positions. And so depending on the background and the feelings of the folks that are nominated and presumably confirmed to those roles could have an effect on not just banking regulation, but also monetary policy as we go forward. Congress, of course, is dealing with some things, tax reform being the most obvious. We also have a debt ceiling that has to be addressed again, and some budget issues that have to be addressed. In fact, there's been recent discussion again about a possible government shutdown as the Congress has to pass a resolution to continue funding the government. And tax reform, of course, is one of the biggest issues that we're going to be dealing with here in the next few weeks. I'd like to turn to the next page and take just a few moments to talk about some of the key economic indicators over the course of the last year. One of the most important of those being employment indicators. We've had a fairly steady and a fairly strong job market over the course of the last year. Non-farm payrolls, which is the key measure, have been growing at an average of about 160,000 per month for the last year. That's down a little bit from last year. You can see in this chart we have had some oddities, 18,000 in the month of September, which was a result of the hurricanes, and then a big strong rebound in the month of October, and that was largely hurricane related. The unemployment rate has been steadily declining. In fact, it's gone from 4.9% down to 4.1%. And that is, most economists would consider that full employment. It's also a level that historically would generate wage inflation. And one of the reasons that the Federal Reserve has begun to normalize monetary policy is because they're concerned about wage inflation. Now, thus far, we really haven't seen that wage inflation, and that's one of the reasons why they're taking a very slow and very cautious approach. The other chart I have up here is the labor force participation rate. This is a measure of the people that are actually out looking for work. And the labor force participation rate remains at historically low levels. Now, it's been on a downtrend. That's a cause from demographics. As baby boomers age and retire, the participation rate is expected to decline, but it's at historically low levels, and that has important implications for economic growth. The red line in that bottom left chart shows the employment to population ratio. And you can see while that has been on a gradual uptrend, it is still well below the levels that were seen before the recession that hit in 2007. The GDP, gross domestic product, is sort of the scorecard for economic growth. The last 2 quarters have been the best back-to-back readings in about 3 years, just above 3%. You'll also note that the last 2 quarters have been right in line with the long-term historical average. And that is somewhat of a relief after many quarters of economic growth that's been below those long-term averages. And consumer spending has been a primary driver. It accounts for about 2/3 of economic growth, and it has slowed recently, but other components have been making it up. The impacts from the hurricanes have not been widely seen in these measures. They tend to wash out over the course of the quarter. One of the other primary indicators that we follow, of course, is inflation. This has important implications for monetary policy and what the Fed is doing. Inflation has been running below the target levels for the Federal Reserve. The blue bars in this chart is the Consumer Price Index, and you can see that those have only recently climbed back up to right around 2%, which is what the Fed's stated target for inflation is. The core rate, however, which excludes food and energy, which are considered volatile components, has been running at a lesser pace. And that red line there is the core rate of CPI. And it's been moving along at about 1.7%. It bumped up in the latest reading to 1.8%. That green line is the Personal Consumption Expenditures Index, the core rate of PCE. That's actually the preferred measure that the Fed likes to follow. It's their favorite inflation indicator, if you will. It's been running well below their 2% target at only 1.3%. The October data was not available before this chart was put together. We just got it the other day. It's at 1.4%. So we saw it move up very, very slightly. But the primary takeaway here is that inflation, while it has been stabilizing and beginning to turn upward very, very slightly, it's still well below the Fed's stated 2% target. The next page, we'll talk about some of the market impacts, and of course this top table shows the primary equity indices in the U.S. And you can see from this chart we've had a tremendous rebound. I'm comparing to 9/30 of 16, and we chose that not only because we're doing an annual report here, but also because it was before the election. And we saw a pretty dramatic shift in sentiment following the election in terms of the equity market, and that has continued through here this year. In fact, we've had over 30% increase in the Dow Jones over that time frame, the S&P 500 at over 20%, and the NASDAQ composite at just about 30%. And they're up very sharply. And in fact, all of the major indices in the U.S. stock markets have been setting record highs very recently. In fact, the Dow, I think, on Monday hit its latest record high. And the bottom table shows a comparison of interest rates over that same time frame. And you can see that virtually across the entire yield curve, interest rates are up roughly 100 basis points over that time frame. Now, clearly that has some pretty important implications for what we're doing as investment managers in fixed income, because as interest rates rise, bond prices are falling, and so the value of your portfolio would be declining in a rising rate environment. However, we also have the opportunity to make new investments at higher yields, and that's something that's been helpful. I don't want to spend too much time going through this slide. You guys can read through this. The important takeaways here are that, number one, the future of the Fed is somewhat uncertain because of all the open seats and because the president is going to be making a number of replacements. However, we do, and the market does expect that the Federal Reserve is going to continue to, quote, normalize policy. We expect another rate hike at the next meeting. The FOMC, the Federal Open Market Committee, meets next week on the 13th. We expect another 25 basis point hike in the overnight Fed funds target rate. The Fed is also telling us that they expect 3 more rates to come next year. However, I will tell you that markets aren't quite so convinced that we're going to get that many rate hikes next year. This next table I'll spend just a couple of minutes on. This is what we call a break-even analysis. And in this, we compare where we can make investment purchases today versus what we expect we would yield if we just kept the money in liquid investments, in money market funds and local government investment pools. The blue line is the break-even line if we follow the so-called dot plot, which is the Fed's own projections for where they expect interest rates to go. So if the Fed raises rates the way they're telling us they're going to, this is essentially the earnings that we have to get in order to match what we would earn if we just left the money essentially uninvested. The little blue dots at the top there is commercial paper yields, and you can see that each of the maturity points out through 9 months, commercial paper yields are well above those break-evens, and they provide an attractive spread and a very attractive investment option for short-term investments. The other dots, these sort of purple and orange dots, are federal government agencies and or U.S. Treasuries. And even those are above that break-even line all the way out to about 18 months. Once we get beyond 18 months, however, the yields on those start to fall below that break-even line given the Fed's projections. That bottom green line is the Fed funds futures market, and this essentially tells us what the markets are predicting the Fed is going to do versus what the blue line, which says what the Fed says they will do. And you can see that the yields on agencies and treasuries are still above where the market expects the Fed funds rates to go. So this creates a little bit of a conundrum for us. We have been favoring shorter term investments because of the rising rate environment. And also because as we get beyond 18 months, those investments don't make sense to us if the Fed raises rates the way the Fed says they're going to. We do, of course, have to balance that with what the market is telling us, and the market is telling us the Fed's not going to be able to raise rates that many times. So this is sort of the environment that we're dealing with, and one of the things that we have been doing for most of our clients is keeping our investment maturities relatively short so that we don't get caught locking in longer-term investments at yields that turn out to be much too low. Okay, now it's skipping around too quickly on me. I don't want to spend much time here on the economic forecast. I think I've covered most of these points already. You know, one of the really important things for us going forward is tax reform and its implications. The market seems to be viewing it with a pretty optimistic glasses at this point. Both the stock market, of course, has been moving, anticipating that we'll get some tax reform that will be beneficial for the economy. But interest rates have been moving as well, particularly on the short end of the curve. And essentially, what the interest rate market is telling us is that if we get tax reform, it should be stimulative for the economy. That would tend to produce a little bit more inflation, and that would tend to cause the Fed to have to react to that and tighten policy and raise interest rates a little bit more quickly. So that's something that we're following very, very closely. This is an interesting chart. These are the yields on Treasury, U.S. Treasury notes at various maturity points. I have the 2-year, the 3-year, the 5-year, and the 10-year. And you can see from all of these charts that just following the elections in November, we had a dramatic increase. I guess you can't see me highlighting it, but we had a dramatic increase in interest rates just following the Trump election. And then things sort of stabilized and kind of held flat through much of the year until we got to September. In September, we had the flight to quality following the hurricanes and also the North Korean tensions. But since that time, yields have moved up very sharply, particularly on the short end of the curve. And in fact, the 2-year Treasury note went from a yield of about 126 in early September to over 180 today. So we've seen more than a 50 basis point increase and 2-year Treasury yields. So as I said, we don't want to be in a situation where if we had bought 2-year Treasuries back in September, we would still be earning a 125 on those, and yet the market today would be more like a 180. And that's something that we've been, very cognizant of and trying to guard against. And it's one of the reasons we've kept a very short maturity on the portfolio. And so with that, I'm going to move into the portfolio now. This next chart you can review pretty easily here. This is a daily snapshot that we do that shows yields across a range of investments, and these are the types of investments that are eligible for the hospital. I would note here, if you look at the table on the right in the middle, it will show commercial paper yields. I mentioned that those yields have been very attractive. And if you look, you'll see that a 6-month block of commercial paper yields around 177. And to achieve that same yield in an agency security in the bottom block there, in the bottom table on the right, I have to go out about a year and a half, about 18 months. So we've favored taking the yield in a 6-month window as opposed to an 18-month window by investing in some high-quality commercial paper as opposed to that longer-term agency security. Moving on to the portfolio itself, this table compares the various funds from 9/30 of 16 to 9/30 of 17. And you'll note that the portfolio balances are really quite stable. One of the things that this sort of hides, because you're comparing the same time period a year ago to the same time period today, is it hides some of the fluctuation that goes on in between that time. And that is particularly evident in the operating fund. Although it's stable from one period to the next, in the interim there is quite a bit of movement. And in fact, in the quarter between June 30 of this year and September 30 of this year, the balance in the operating fund declined by about $100 million. So a pretty substantial runoff as you have your daily operating needs coming out of the operating fund. And as Ms. Clark was pointing out earlier, we're approaching the time where we will see a few $100 million flow into that operating fund. And so we'll be busy investing a lot of those funds, and the operating fund in particular will be invested at the short end of the curve so that we can fund those monthly expenditures that you're having to deal with. The following page shows some of the portfolio characteristics. A couple of important things here. If you look at the values on the table in the top left at 9/30/16 and comparing those to 9/30/17, the average yield on the portfolio went from 0.86% to 1.22%. So we saw about a 36 basis point rise in yields on the portfolio. And of course, that's reflective of a short average maturity where we're able to reinvest frequently at higher yields, and we've been in an environment where yields have been climbing. We also see that about 15% of the portfolio was invested in certificates of deposit, and roughly another 15% in bank deposits. We have about 30% of the portfolio in commercial paper. And again, those are short-term investments. They're very liquid and very highly rated, and they provide very attractive yields at this time. We also have about 16% of the portfolio in U.S. government agencies and about 5% in U.S. Treasuries. And then there's about 20% in local government investment pools. These are essentially money market funds, provide you with overnight liquidity and a very attractive yield. The weighted average maturity in the portfolio at the end of September was about 178 days, so just short of 6 months. That's up just a little bit from a year ago when it was about 160 days. But again, it remains a very short portfolio. And as you can see in the bucket there in the maturity distribution in that middle bar chart at the bottom, you have about a third of the portfolio in overnight options and about another quarter of it maturing in the next 90 days. And of course, as you're sitting at September 30, you're running into the low point in the cash cycle, and so you need a lot of liquidity. If we look at this at the end of March, roll forward 6 months, it'll look a little bit different. We'd have a little bit less invested in overnights and liquid investments, and a little bit more, a little bit further out the curve. And then finally, this is the benchmark comparison, and this compares the portfolio yield over time. The top line is the hospital's yield. The bottom line is a group of benchmarks, including TexPool, which is one of the local government investment pools. We also compare against the 3-month and 6-month and 1-year Treasury curve, The most relevant, of course, at this time is the green line, which is the 6-month, and the CMT is the constant maturity treasury. It's an index of treasury securities. Since your portfolio is roughly a 6-month average maturity, we like to compare it against a 6-month treasury benchmark. And the gap between your portfolio and those has been narrowing a little bit here recently. That's to be expected in a rising rate environment as the portfolio lags somewhat. That should rebound here as we have a lot of funds coming in the next few months, and we'll be reinvesting some of those incoming funds at some higher yields. And I think I've probably been babbling on about 15 minutes or so now, and I'll be happy to wrap it up and answer any
questions
questions
for Greg?
if I can.
Charlie, are you confused what board meeting you're in? Isn't this just like your banking day every day?
Yeah, it kind of is, but I think, having gone back to finance, and I know Trent's chaired finance, and Steve, you've done it, I think the philosophy was to stay short from an investment standpoint. I think that's what we're achieving here. There's a lot of uncertainty out there. I will also say that Jay Powell, the new head of the Fed, I wish he was my uncle, because I have Fed regulators, but he's not. So, anyway, but yeah, it's, I think it's just a little bit of deviation from where we used to be, say, 5 or 6 years ago, when everything was in short term, just cash. And I think by conservatively investing in some high rate, commercial paper, you've been able to increase the yield off that. So I think we're benefiting.
The portfolio has benefited from money market reform.
Right.
Some of you have probably heard about the SEC's money market reforms, and those reforms have contributed to wider spreads in commercial paper, and we've been able to take advantage of that, particularly in the operating fund. I will say that the operating fund being the largest of the funds in the portfolio and having very short cash needs, it tends to pull the weighted average totals down a little bit. Some of the other funds have a little bit longer average maturities. In fact, the JPS Future Fund has an average maturity just a little over 500 days, so it is a little bit further out, but by extending out, you're able to capture a little bit of additional yield. But overall, the portfolio is very well positioned for the rate environment we're in, and you should continue to see the yields gradually move higher.
Great.
One of the things that is not up there from a volatility standpoint, one of the things that's not up there from a volatility standpoint is some of the relaxation of the Dodd Act and Oxley and some of the other things and regulations. Do you see that being a change and a factor for some of the minimizations of the higher levels of regulations that went in 10, 12 years ago, and what that means?
Okay,
Yep.
before you answer, can you put your question a little bit more basic?
There were regulatory reforms that went in, particularly by Senator Dodd of Connecticut years ago, that some in the industry find as restrictive. And so when those regulations are relaxed, does that open up the marketplace, and does it create greater opportunities for us, or will it be a level of volatility that would not create a good environment for us? And I know that's as much crystal ball as some of the other stuff like a hurricane or whatever, but what is y'all's perspective of that? Because it looks like that could be your 8th element up there of the reduction of those regulations that went into place.
Yeah, and there's no question that I'm going to tread lightly here because you start to bleed into politics. But certainly from the market's perspective, the election of Donald Trump has brought in a new regulatory regime. Sure. The expectation is that the regulatory environment would be relaxed, would be more business friendly, and that's generally bullish for the economy and certainly for the equity markets. So it's one of the reasons we've seen such a dramatic run-up in the equity markets is the expectation that the regulatory environment would be more friendly towards businesses. Mm-hmm. That in turn has an impact on the interest rate environment because obviously an economy that's growing more quickly perhaps generates more inflation, causes the Fed to react, and so forth. So we've certainly seen that, and I think that's something that we're going to see as well coming out of the Fed, particularly with President Trump having the opportunity to appoint so many new leaders on the Federal Reserve Board of Governors. The Board of Governors have 7 members. They serve a 14-year term. He's going to appoint 4 members to the Board of Governors, and they will be serving a very long time. And they have a tremendous impact on the regulatory environment. It's the Fed who takes The laws that Congress writes, the Fed has to put them into rules and interpret them and enforce them. And there's no question that banks have been under the thumb of the regulators over the course of the last several years. And I believe there's certainly an expectation that some of that burden will be relieved. And that's one of the reasons we've seen such a run-up in interest rates since a year ago. On the longer end of the curve, by the same token, the longer end of the curve hasn't moved as much. We've seen a tremendous, what we call a yield curve flattening, which basically just means the difference between short-term yields and long-term yields has narrowed. And so the long end sees the benefits from the economic growth, but right now we're not seeing inflation. The long end of the yield curve reacts to inflation, and we're not seeing inflation. And in fact, we have a Fed that is beginning to tighten policy, and the long end of the curve can look at that and say, okay, well, they're going to keep inflation under control, so I don't have to adjust my yields higher to compensate me for inflation.
Thank you.
A lot of uncertainty.
Yes, sir.
But it's a different uncertainty than what
Totally
we had
agree.
5 years ago or 6 years ago. I mean, there's always uncertainty to it, but
I think Greg's assessment is what we hear almost daily from our own advisors and things like that. I mean, it is a unique time. I think Greg's slide indicated no president's ever appointed the Fed chair, the vice chair, and the head of the New York Fed. I mean, those are unusual. And when you think about all the administrative people below those individuals who are waiting to see who's going into those jobs, and they probably have been under the leadership of people who maybe philosophically is going to be changing now.
Yes, sir.
So there's a whole lot of movement within that. But again, I think you hit it right on, Greg.
Thank you.
Which doesn't change the hospital. The only point I want to say is, since I've been on the board, and most of the people I see on this board now, the hospital district has always taken a very conservative approach to our investment portfolio, just because we might be allowed to get into some new thing that's out there with a greater risk tolerance than what this board should elect to do. Is always comes back to this board's decision. I think we've always stayed conservative. So anyway.
Trent?
One question, I should know what that is. Why do we see on the account summary, why do we see the?
Trent, hit your mic,
Oh, I'm sorry.
if you don't mind.
I'm sorry, Greg. Why do we see the ending book value and market value down as opposed to beginning values of 9/30/16? Is that just additional liquidity demand on the fund?
The book value is primarily impacted by cash flows in and out of the portfolio.
Okay.
So the decline in the value of the portfolio is really a reflection of having less funds.
Just cash that we needed.
Because
Okay.
cash spending.
Thank you.
Now there is, you'll note here on the account summary in the next line down, there is a slight unrealized loss on the portfolio, $114,000. And that is a reflection of the market value of the portfolio falling as a result of interest rates rising. There's an inverse relationship between price and yield in the fixed income market. So as interest rates have risen, the value of the existing positions in the portfolio have fallen.
Okay.
And again, that's one reason why we try to keep the portfolio very, very short.
Sure.
We don't want to be in a position where you have a $2 or $3 million unrealized loss in the portfolio.
Yeah. Okay, thank you.
Other questions for Greg? Thank you very much.
Thank you, gentlemen.
Thanks, Greg. Appreciate it.
Excellent presentation.
I don't know how you give that presentation and stay out of politics.
No, that's right. All right, we'll move on to item 5B. Wanda. Good morning. Yeah.
Okay, I'm saving us some money again.
Speaking my language.
Always a good thing.
That's a good intro.
First, I have a pricing agreement between Stryker Instruments. This is for the purchase of our Stryker Neptune system. We did put this out for an RFP. This is something that we currently use in the operating room, but was looking at getting better pricing when it came time to renew this contract. We are, this will save us $39,989 annually, and over the course of the contract, $119,967,000. This is something that we use pretty much in every case in the OR for the extraction of the fluids during the case.
Okay, any questions for
Any
Wanda?
questions?
Okay.
When you start with that introduction, you get fewer questions.
I'll remember that.
Motion by Dr. Weber, second by Reverend Emerson. All in favor, please say aye. Opposed? Motion passes. All right, thank you. And item C.
Okay, next is also a pricing agreement with Stryker. This is actually a cost avoidance. It is for our surgical hoods. It came time to renew that contract as well. And they were coming out with a new product that was going to be at an increased cost. However, we were able to negotiate to keep our pricing where it was, which will be a cost avoidance for us. So, and we also, by doing this new pricing agreement, will save us of the repairs, because they are going to do all of our repairs under this contract for the next 4 years. So we will not have
Awesome.
repairs. And this is part of our Vizient contract, so.
Great. Any questions for Wanda on this item? Entertain a motion. Motion by Mr. Bose, second by Mr. Powell. All in favor, please say aye. Opposed? Motion passes. Your third item, item D.
Thank you. Lastly, I have, this is a professional service agreement between Neurodiagnostics. We did put this for an RFP, but this was the only vendor to respond, and this is the vendor we have been using for many years. It's used in our operating room primarily by neurosurgery, and this does the neurological monitoring during the cases. This will lock in pricing for us for the next 5 years. This company, all their staff is certified. They do remote physician interpretation, which is a joint mission requirement. And they provide all the supplies and equipment for this procedure. So this is just renewal of that contract.
Okay. You've heard the description. Any questions for Wanda? Entertain a motion. Motion to approve by Mr. Bose, second by Reverend Emerson. All in favor, please say aye. Opposed? Motion passes. Thank you, Wanda.
Thank you.
PIA. Item E. Good morning.
Good morning, everyone. This morning, I would like to ask for your approval for 3 staffing contracts. We did go out to RFP to identify new staffing agencies. We did award 6 contracts, but right now we have 3 that we would like to ask for your approval. And this is for items E, F, and G. The first one is Alliance Staffing. The estimated cost for this is $200,000 annually. And this is for clinical staffing.
Okay, let's take them one at a time.
Okay.
We'll knock them out. So we'll do item E. That's the first one you just described, right? Okay.
It is.
Entertain any questions for PIA on these? Entertain a motion.
Okay.
Move approval.
Motion by Mr. Bose, second by Mr. Powell. All in favor, please say aye.
Aye.
Opposed? Motion passes. All right, item F.
Next one is GHR Healthcare Resources. This is for clinical and non-clinical. Our estimated cost per year is $200,000.
Okay, any questions for PIA on this item?
So moved.
Motion by Mr. Petty, second by Mr. Bose. All in favor, please say aye. Opposed? Motion passes. Item G.
Okay, and item D is GHR Healthcare Resources. The estimate is this was $200,000 annually as well.
Motion by Mr. Powell.
Second.
By Mr. Bose. Any questions for PIA? All in favor, please say aye.
Aye.
Opposed? Motion passes.
Thank you.
Thank you very much. Mr. Mendenhall, you're up next.
Thank you. So in front of you this morning is a renewal of our service contract for all of our Cisco networking equipment. that connects all of our endpoints throughout the hospital, as well as connects all of our community health centers to the core that is in our data centers here. So this is a renewal of that contract for 3 years. We did get a 10% reduction in our cost because we put it out for 3 years. This equipment has a useful life of 5 to 7 years, so we thought that was a pretty good thing to do to get a reduction for 10%.
Okay, and this is consistent with what we got in place now?
Yes, absolutely. We just finished a 3-year contract with them, and this is renewing another 3 years with them.
Got it, okay. Motion by Mr. Reverend Emerson?
Second.
Second by Mr. Bose. All in favor, please say aye.
Aye.
Opposed? Motion passes. Thank you, David. Ms. Wieland, item I.
Morning.
Good morning.
Good morning.
I'm here today to ask your consideration for the approval for the First Amendment with Philips Healthcare for our PAC system, and that is our picture archiving communication system where we store our images. It is a 5-year contract, and it reduces the price per study from $2.73 each to a $2.30 cost per image. So I'm asking for your consideration today.
Okay. Motion by Reverend Emerson.
Second.
Second by Dr. Weber. Any questions for Kathleen? All in favor, please say aye.
Aye.
Opposed? Motion passes. Thank you, Kathleen.
Thank you.
Mr. Pillai, what'd you break today? Very expensive plumber.
Good morning.
Morning.
We saved you for last for a reason.
Oh.
So in the last 6 months, we've been seeing during our peak operating times in the kitchen an increase in drains backing up, usually up to the drain without flooding but causing a foul odor. And each time the plant operations team would flush out those lines. On Friday, November the 24th, we started to see the drains back up with some water reaching the floor, but then it receded. On Saturday, November the 25th, during the afternoon, the drains backed up again in multiple areas of the kitchen and putting water onto the floor. On Sunday, November the 26th, the drain backed up in the dishwasher machine room, causing us to stop running the machine. And during each of these events, the plant operations team and the environmental services teams worked together to contain the water and to keep the kitchen clean and free from grease. So we immediately contacted 3 different vendors. Each vendor assessed the piping and provided us with an estimate to repair. Quantum Mechanical provided us with the lowest estimate, and they were able to get in and begin the repair the quickest. We kept the kitchen clean and continued kitchen operations, but had to serve our patient meals on disposables since we were unable to operate the dishwasher machine. On Wednesday, November the 29th, we were able to make some temporary changes to the kitchen operations to minimize the flow of water that's drained in order to start using the dishwasher machine again. The cost to replace and upgrade the collapsed cast iron 4-inch pipe to a 6-inch PVC pipe is $65,000. However, in the process of replacing the pipe, they have discovered that the storm drain was incorrectly installed and was feeding into this pipe and will need to be redirected to the proper drainage system. This repair is ongoing and underground. We are expecting the full scope of work and dollars by next week. Today, I'm requesting the Board of Managers to consider approval of the emergency actions taken, including exemption of purchase of repair services from competitive bidding. The agreement between JPS Health Network and Quantum Mechanical for the emergency repair of the collapsed kitchen drain is anticipated to be available at the board meeting next week for approval.
Okay.
Mr. Chairman, let me comment a minute. Mr. Rule and Mr. Pillai called me early last week and said we got the problem, talked about how we would resolve it, and certainly this is an emergency, had to be addressed. So what you're voting on as a committee is recommending to the board to approve this as an emergency expenditure. What you're approving, the $65,000, is already, an PO has been issued to address that emergency. We will have an agreement completed tomorrow. I just got we're in the process of getting the last components of that to be the agreement itself. That will be posted on your website tomorrow afternoon. So everything's going to be.
Please, code red. Main hospital, lower level dietary. Service line, attention please, code red.
You may-
Lower level dietary. Service line.
You may have another emergency,
Attention please,
Jamie.
code red. Lower level dietary. Service line.
You want to adjust that number now, Jamie?
That would be a different one. But what you have before you today is to approve a recommendation to the full board for next week that this is an emergency, it is being addressed, it's based on a PO right now, and that you will have an agreement not just for the emergency expenditure, but for the full amount to correct the problem.
And the motion will cover both those issues.
Yeah, correct. And you will have something that will not be posted on consent, it will be actually an action item at the board.
Then based on it falling within the emergency, I would make a motion we approve.
The question, does the 65,000 include redirecting the storm drain
No,
line?
no, that's what
So
we're
that's
still
gonna be a
trying to
different
determine.
contract?
Okay.
No,
That's-
that addresses
that's
the
the
emergency
best.
issue,
Oh,
the
we got another one
65.
coming.
Yeah, well, on top of that, you'll have another one, and I'll have that hopefully to you by tomorrow. Jamie's working on that right now.
That is, we may have it all.
Yes.
We'll leave this open, right?
But we certainly approving the 65.
Yes, sir.
And we're also approving under the emergency provision that until we see the final numbers of the board, Jamie and staff are okay to continue.
We have some level of predictability on the second level. This one was an immediate emergency that we needed to take care of. Once we found the problem, now we can come to y'all and tell you what the price of fixing that is. This one, we had to take the action immediately.
Right.
That cast iron line, Jamie. How old was that cast iron line?
Older than Trent
I think probably over 50 years.
John Peter Smith put it in himself.
I suspect.
Chuck supervised, right?
Mr. Chairman, I move the
John Peter
motion.
Smith get a lawyer to get that, but he hired somebody to do it.
A motion by Mr. Powell, second by Reverend Emerson. Any further questions for Jamie? All in favor, please say aye. Opposed? Motion passes. Thank you, Jamie.
Thank you.
Because it's over $50,000, you are approving an exception to the bid.
We had to spend that.
Any items enclosed?
No, sir.
No.
Any questions from legal? Any items?
Yeah, I have my normal announcement for the board. In the month of November, there were 28 contracts that were negotiated under $200,000. That list has been posted to your website.
Thank you very much. All right. Any questions for council on any of that? I think we are at the end of our agenda, and we're adjourned.
Wow.
Yeah.
Wow. All right.
Pretty efficient.